Okay, let's start with FOXA. So FOXA is a worldwide entertainment company and operates filmed entertainment, TV network, and 27 TV stations, cable television network, satellite television broadcast system. Satellite TV operation include 100% of Star Television in Asia and Blue Sky in Italia, in Deutschland, and so you can read it here, right? So it's mostly networks, distribution networks, but also movie production. Now, let's have a look at their revenue. We can see that revenue for the last 2 years from 2014 is kind of slows down. So it was 1455, and we can see that it was 1435 in 2015 and 1445 in they're planning to have a bit higher than last year, but it's projections, it's not real revenue. And then they show they're planning to grow. Now, if we look at their earnings, we can see that despite the drop in revenue, they still managed to get higher income. Always go to total net profit. Is it higher? And we can see that total profit dropped down. So it was from 3.7 billion to 3.6 billion. And they are planning to have this year 3.1 billion. So the only the way they could achieve this type of growth is by buying more shares. So they're aggressively buying their shares. So that's how we understand it. Okay. And price union ratio in average, we can see that highest point is about 20 and the lowest point 13. So it's similar to Disneyland. We could see it as well. The lowest point in value line was 13 and highest was around 20. And at the moment it's 14. So we understand that actually 21 first century, it's trading at a lower level than Disneyland, just looking at these two parameters. Okay, then if we look at the current assets and current liabilities, the situation is better than Disneyland because look at this, they have 15 billion in assets and they 8 billion in liabilities. So they have 7 billion here, positive kind of assets in current assets, which is good. We remember Disneyland has 1-to-1, so it's similar. Then we look at long-term debt. We have 19 billions of debt and 15 billion capitalization. Wow, that's where the difference is, because Disney had about 20 billion debt, so it's similar to that 22 billion debt, but capitalization was 150 billion, so 3 times. So here they have quite high level of debt, and always if we look the long-term interest, they are going to pay 1.1 billion. What's their net income, net profit? 3 billion. So they can cover the interest, right? And for us, it's important during 5 years, 3.5 billion. So they actually easily can pay this, right? So 3.5 billion in the next 3 years, their net profit every year 3 billion. So that's kind of tells us that they're secure. Also, they have 7 billion in current assets. And when you read this report, you'll understand that actually the reason why they're dropping it's again they're losing subscribers. Okay, when you read about this company, and I presume they go somewhere. Okay, subscribers if they have this. Of course, there is quite a lot of free stuff in the internet. You can watch it practically pay nothing. But at the same time, it's more convenient just to have a subscription and have quite a lot of channels, especially if you have kids. You don't want kids browse internet and get to some very weird stuff. So you want to secure and probably you buy this channel and you know that kids watching cartoons or something like that. So in this particular case, so we see the problem here is similar to Disneyland. Now, from growth perspective, we can see that the last 5 years, the company sales level was growing only 2%. Disney was 7%. Earnings were growing 11%. Disney was growing 10%. No, actually 15% growth was in Disney. And at the moment, they are planning 5 and 10, similar to Disney. So the growth from earnings perspective, they expect similar. They also pay dividends. Okay, that's a good stuff. So if we compare these two companies, we can see that the stability of growth is not as good as in Disney, okay, but from valuation perspective, this company is selling now at more attractive prices. And we can see that value line tells us that they expect the growth 25%, where at Disney they were telling only 10%. So within the next 3 to 5 years, at the highest point, we can expect growth 145%. Okay. Now I've done also value line like TCN. Okay, I'm not going to go into details, but uh, if you look at quality, it gets 36. It's not 4, so it's not 4 by 4, it's not above 40, but it's strong 3. Okay, so this company not as good as Disneyland, but still good. Okay, in that particular case, and it's losing on the growth trend because for the last several years it didn't grow. Even earnings were growing, but sales weren't growing. Okay, and it has quite significant debt, 38%. So okay, so that's, and industry rank in general is lower than any other. So that's where it's losing. But we know that it's strong company. But when you look at price, it actually gets the highest possible score, 52. So out of, if we look at Disneyland, right? So it trades and it has a potential to go down. Where if you look at TCN prediction here, right, we can see that the trading level where you can trade between from $26 to 62, right? And between 26 and 38, it's a buying price. But at the moment, the price is 23. So it's actually below the lowest point. So the price earning, the multiples which they're trading at now, it's lower. And the reason for that, because the earnings per company dropping down, the net profit is going down. So that's why the multiples are even lower, because people expect or afraid that next year earnings would be even less. Okay, so that's the reason for that. But based on fundamental analysis, this company is undervalued right now. Okay, compared to their past performance, and also if you compare with Disneyland, it trades at lower multiples. Okay, now earnings would be 2nd of November, book value 7.2, but again remember probably part of it here is goodwill and etc etc. Now if we look at technicals of this company, so always I look at the picture like that first. So I can see in 2009 it dropped to $5 from 23, so quite a significant drop. Okay, actually Disney lost about half of its value. Even their earnings drop only 20%, the price drop halved. Here it's even more, okay, from 23 to 25, so it's nearly 5 times. And then it was quite good growth until $37, and now it's 23. So it's lost about 50, like if you from here 30% of its value, maybe 35% of its value. All right, and then we look at the closer trend. So we can see that from, that's the, if we take this as the highest point, okay, and it's done few rolls already, right? So it's kind of maybe, okay, something like that. So it's one roll, two mini roll, and a third roll. Now, if we look at this, and of course within the roll, always there are rolls as well. So there were rolls here, and we can see it's 1, 2, 3 rolls here as well. Okay, and if we look closer at this particular trend, on the downtrend which is happening now, we can expect, if based on this 6 months, like nearly yearly trend, it still can has a potential to go down because it's downtrend. But even within that trend, it might go a rebound to about $28. So $28 moved from 23 to 28, it might give you what, $5, so which is about 20%, a bit more growth. Another thing which you need to take into consideration, it's the lowest level. So we can see that that's January, it's dropped to this level and then bounced. So it's easily can go to the same level and bounce again. Okay, so if we go here, so you see it's one drop here in September. It was Chinese crisis here. Then we can see January drop, and we're approaching to the same level. It's similar to Disney. It's holding its grounds on these levels. Okay, and it's already one, two, and its third time is approaching. So if we manage to hold this, who knows? Maybe it's going to go for parallel trend because we can see that's if we go here, this trend like that. So you can see this roll, it's achieved the same level. So it might be going as a parallel from 23 bucks to about 30 bucks. And if it happens like that, it's $7 profit, which is 30% profit. And how long does it take? One, two, three, four, about 4 months. So that's how you can generate about 40% on FOXA. So remember, FOXA is not excellent company from quality perspective. Also remember that it's losing net profit, but it's still stable company. And based on technicals, it's on a downtrend, long downtrend, but within shorter period of frame, it can pull up down or pull up, and you can make some money on the move. But at the same time, if it breaks through this line, it can continue to this trend. So you might see it in a range of $17 or something like that. Okay, so remember about this. But if you look at technicals here, indicators, they're all in the right place. Okay, we can see that stochastic crossed already 20% line, same with the RSI, and we can see MACD in over sold situation. Okay, so it's minus below zero, so it can go up as well. So that's FOXA. Now the strategies will be exactly the same. So you can buy company and hold for long period of time, but I wouldn't probably buy FOXA because until earnings improve, right? Because Disney, their earnings growing still, so it's good. So this company, FOXA losing their grounds. Okay, so I will probably won't buy it for long term. But if you're speculating and playing short term, you might, because it's kind of undervalued right now. So if you do this, but you have to understand your risks.